For more, Damp Spring Advisor CEO Andy Constan joins us now. Andy, great to have you with us. The last time you were on, you made a fantastic call. I mean, you called for the slowdown. And I guess, our question now after you make such a great call is what is your next call? Because it sounds like, you called for the scare and now you think the scare is going to become a reality.
Right. And I think that's right. Last time it was about the Fed on pause. They're still on pause. Financial conditions tightening. They've eased a little bit, but they're much tighter than they were last fall. And then it's all about the Trump agenda. And the Trump agenda is, except for deregulation, is anti-growth. And so that hasn't actually started hitting the economy yet. So we definitely had a growth scare. Bonds rallied a lot, stocks fell, and that's probably over. And what's going to happen and what I think will drive a second leg down is actual growth will slow more than expected.
Hey, Andy, it's Karen. First of all, excellent call. So what do you think? I know you said some of the policies are inflationary. So are we looking at a stagflation? I know Trump trying to talk interest rates down, but that's not going to really affect the 10-year, only the front of the curve.
Right. I think what is true is that the policies are anti-growth. In terms of inflation, tariffs are, as I think now the Fed is telling us, at a primary level, looking through the initial price change, level change, and not assuming that it's going to be inflationary, but you will have a short-term inflation rise that they're going to look through. Immigration is inflationary because you reduce the labor supply. The budget cuts, the expenditure cuts are anti-growth, but also disinflationary. So I think inflation is less a big deal right now. Of course, if the tariffs do have secondary impact and start causing a more persistent inflation, then the Fed's going to not be able to cut as promised. But for now, I think it's all about growth and the anti-growth policies.
Andy, it's Tim. How about credit? Because there's been times, at least for the last month and a half, when equities have been extremely volatile. People have said, look at credit markets. They haven't budged. If you look at the high yield option adjusted spread, I mean, it's actually moved 35 basis points in the last month. And so I'm just curious your take on this, because typically we are always following our clues on the equity markets if we're smart by following what credit's doing.
Right, sure. So credit generally moves less than equities until it moves quite a bit more. And I think we're in that phase of it moving less than equities, outperforming equities, but starting to get the sense that there's this sort of convex move wider in credit spreads. But I think that's going to take another leg down and actual weakness in the economy to happen. And as it relates to Treasury bonds, the Fed's on pause. So the front end of the yield curve is not likely to rally much. But if we continue to start seeing more slowdown, you might see a flattening where the long end continues to rally a bit.
So, Andy, how are you positioned for this anticipated second leg lower?
Right. So I think bond markets are very boring right now because of what I just said. They're very fully priced for a slowdown. Credit, as you said, as we were talking about, could be an interesting place to be long protection. But I don't have much exposure at all in fixed income. I am short equities and planning on, for now, because this second leg may take through, say, for instance, the earnings season upcoming, to become an actual slowdown. I am beginning to short equities again. I'm short them, and I'm going to add shorts on any rally.